Hey everyone, we got another deal here for you. This one is an interesting one, an all season landscaping company based out of Missouri. Mainly interesting because all season landscaping is kind of tough to get, but I mean, landscaping companies make really good money if you can keep your guys busy the entire year. So we're going to go through this just like every other video. We'll break down the deal, some red flags, green flags, whatever else. Then we'll go over and we will look at financials and we'll basically dive in from there and break it all down. All right, so all season landscaping company based out of Missouri here. We have 2.1 as the asking, SDE at 650. Not a horrible multiple here. Looks like it might be listed by the business owner themselves rather than a brokerage, which always kind of a good sign to be able to get into the details. However, that does mean data is usually less regularly available. You do have to wait and make requests, and you have to follow up and be on top of it. But revenues at 3 million, SDEs, I'm sure it's probably closer to 550 or 500. Not a bad margin, kind of low, but it basically tells me either they're investing a good amount in equipment because likely there's capital expenditure here to keep up, whatever it is, lawnmowers and leaf blowers and all that, or a good chunk of that margin may be tied up more so in structure, because at $3 million in revenue, it's a very sizable landscaping company. There's layers involved, right? There's sales, there's management for the crew, there's field managers and supervisors and so on. So we have commercial and residential. That's good. So that probably is where the year round comes in, but also commercial contracts, good recurring revenue because they're big and chunky, sometimes at least. Uh, Developed a strong name for itself. We don't have anything around when they were established, so I'm guessing there's at least a few years in business to build up that level of portfolio or that level of active client roster. But let's see, 400 active clients, very solid, spanning 4 counties. So at least they are actively looking at where their geographies are. They're not just going and taking clients everywhere and then having to worry about paying a bunch of time on the road for no reason. Let's see. So revenue mix is 2/3 business accounts, 1/3 from homeowners. Kind of expected because, again, commercial contracts tend to be larger dollar values. It's hard to keep a good balance there unless you have at least one really solid like door knocker that goes out with your crew all the time. That's generally how with these types of companies you grow pretty drastically and pretty solidly and build those concentrations. It's just your guys are out doing their lawn care. Cool, let's door knock the area and add some more houses to the postal code or the zip code. So lawn maintenance, custom landscape builds, that makes a lot more sense for the revenue numbers. Hardscape installations, that also explains the margin because now you have cost of goods. It's not just labor arbitrage. Irrigation systems, drainage solutions, lighting, winter snow, and ice services. This kind of makes sense for why it's year round, but this is really a lot of services. I've seen companies that scaled really well to like 2 million, 2.5 million in revenue in this space, where their margins are much better, like closer to $1 million, right? Like 40% net margins. Uh, and the thing is, this is what tells me that the reason why their margins aren't quite as good, even though they've scaled. There's too much going on where you have to have such a wide range of people and tools and equipment and everything else. Whereas if all they did was lawn maintenance, irrigation, because that has an inherent yearly contract with it, where you go in and you turn them down, you go in, you make them ready for winter, and then after winter you come back in the summer and make them ready to go again. So lawn maintenance, irrigation systems in winter, snow removal, ice removal, those main three things are all recurring revenue. Yes, they don't have nice big chunky dollars coming in all the time, but if you have a 400 or 500 client active roster in that, between commercial and residential, it's pretty decent. Like, you're going to do probably really similar profit. I mean, it would probably cut their revenue down a good chunk, maybe to like 1.9 million or 2 million flat. But I mean, their profit's not going to be vastly off. It'll probably still be 500 grand when all is said and done. So I mean, interesting nonetheless. 80% repeat business. That's good. So they do have supervisors. They have seasonal pools. So pretty much, what I said, right? They're paying for the management structure, which is there's nothing wrong with that. They're basically going from what would otherwise be, 5 or 10 guys in a truck to a proper company. That's why you're paying out, and there's not as much margin going down to the bottom line. Uh, they own real estate assets. I'm wondering if that's included in this price. So ownership of real estate assets adds long-term security. Very interesting. Owner stepping away to focus on personal and professional goals. Not a good thing to hear, but is willing to remain involved as advisory. So main reason especially if this is the seller just selling, and you clearly hear have supervisors, reliable pool of labor, and a committed management group. Why does it matter? Right? If you just have to go and spend more time on something else, you should easily be able to. And if anything, just hire to replace, and you still cash flow. So this is not a great explanation. Brokers do this less. They put stuff like this less because obviously they know this isn't a good explanation. But if you are a seller, then you're going to look to list yourself like this. In the case this is that, it definitely looks like it. You really don't want to put this as the reason. This is not a good reason to sell. If it was, you're relocating or you didn't have management and now you're saying, yep, I got to step away because I can't keep doing 50-hour weeks, reasonable, but it's not a good reason at all. Remote advisory for 6 months, also not great. If they're already remote, different story, but it seems like that's not the case. We got employees here, so 2 full-time. That in itself is directly contradictory to this. So maybe that means they only have 1 supervisor and 1 manager. 5 part-time. I'm assuming that's some of the seasonal pool. So, I mean, for this amount of people, this is a lot of revenue. So this is kind of interesting. Either way, interesting business nonetheless. Let's go and break down the numbers here, and we'll see how it pans out. So asking price, we'll put it in purchase price, cash flow. We're just putting this into our quick vet calculator, accessible to everybody if you want to play around with it, just so we can break down these numbers here. So cash flow at 650, like I said, it's probably closer to 550. The reason being, you're going to have to do a couple things. One, you're going to have to account for the owner, right? Clearly, 2 full-time, it's probably the manager and supervisor. That's not enough. So maybe, and I'll be somewhat, not quite as conservative as I usually would be. Maybe we'll call that something like 80 grand a year. Um, I don't know the Missouri market area, but if this was like in Florida or this is in North Carolina or something, I'm sure this is probably on the lower end of what realistically a solid general manager should cost for a landscaping company. But I'm going to put that in just assuming that it's not a full time 40 hours a week that the owner's currently putting in. Discount on cash flow. I'm actually going to put this at, I'm going to leave it at 5%. I was thinking 0, but I'm going to put it at 5% because I think as long as real estate is actually included, this real estate they're mentioning is actually included. I'm sure there's still discretionary of like cell phones and cars, whatever else in there that are probably not able to be proved, and that we probably need a discount here. So about 30 grand a year, I'm going to say is within that, and we're going to carve that out. And I'm going to assume you're going to structure working capital as part of the deal, basically meaning you're going to get 1, 2, 3 months working capital from the seller. So let's calculate and see here. And so assumptions we're making here, just to break it down, we're assuming SBA. So that's where the 10% interest rate comes in, 10-year amortization comes in. I'm going to assume that you're going to roll due diligence and buyer injection, everything else. So basically assuming that cost of closing for the lender, SBA guarantee fee, your closing costs and due diligence costs, getting a lawyer to do the purchase agreement, financial folks to do the proof of cash or otherwise. We're assuming all that's rolled in, 4% of the purchase price. And then assuming you're putting 5% down against project, because that's what's required based on new SBA guideline. And you can see here what that breaks down to. It's basically, roughly about $200,000 between 113 that you're putting in and closing costs being rolled into the deal, into the loan, I should say. And so we have a couple of variations here just to break down what it looks like. Their price is not crazy, is the thing. So, even with just a small 10% note, so seller holding back 200 grand, they get, roughly it's based on purchase price, they get like 1.8 cash on close. The the debt service, 300 grand, your net free cash flow is 229 after you account for replacing what the owner's handling. If you're going to step in on that and maybe you take a salary separately after everything, I mean, it's basically 300 grand in debt service, 300 grand in cash flow, a full 2 times debt service ratio. So solid. But I would say somewhere along these lines is probably more where, if I was advising a client on this is more where we would feel comfortable, is coming in 20% seller note. So they're going to hold back 400 grand. They're going to get something like 1.6 cash on close. So effectively around 2.5 times cash on close, assuming that, historical financials and everything line up. You're going to end up with a $1.7 million SBA loan. Your debt service on that, just under 280 a year. And after replacing that owner responsibility, you're cash flowing just under 270. So close to a 2 times debt service ratio. You got wiggle room in the case there's other stuff that happens. Maybe some of the commercial contracts are very tied to the existing owner. Maybe there's a rocky transition, whatever that is. You have leeway there, but you also have cash flow to reinvest in growth. And reality is, for a company like this, it's getting someone on the ground, door knocking, and getting those sales to increase your residential contract base. And that in particular is really where the most long-term bankable cash flow is. But very interesting deal nonetheless, especially if it's actually listed by the seller. All that said, if you're on YouTube, hit subscribe, hit the like button, always helps. And feel free to comment down below any types of deals you want us to be looking at. Are there particular industries you want us to go and look at and do some more breakdowns in? Any particular areas? Always happy to accommodate where we can. See you in the next video.